What are the top 3 categories of business KPIs that you should focus on first in your business? The ones that we like to focus on are the ones that are going to give you the most bang for your buck. And what I mean by that is there is an endless list of KPIs that you could focus on. And there are multiple categories of those KPIs. But what we're most concerned about when we work with our clients, and frankly, what our clients are most concerned about, is what are the KPIs that are really going to help me not just understand the results of the business, but that are really going to keep us on track for the short term and the long term. Honestly, one of the biggest things that happens to a lot of businesses is that they lose sight of or aren't tracking things that will help them know if something is not going the way that it should be going for the long term. In other words, if companies aren't keeping track of their customers, how much it costs to acquire a customer, the value of those customers over the lifetime of that customer, they can get very caught up in simply looking at revenue and not understanding the implications of what's going on underneath that revenue. What is the customer's behavior? What are your customers trying to tell you with their behavior? If it takes a lot of marketing dollars to get a customer in the door and they only buy once, that could be telling you things about your marketing efforts, about your exposure in the broader marketplace, as well as customer service, service delivery, how well that service is performed, and or how much they like your products. Now, keep in mind that some customers, it's a one and done deal. As an example, if you own a roofing company and your customers are only going to ever get a roof if there is a hailstorm or if it wears out, which it's 20 years between roof replacement, then that's a little bit of a different cycle than what I just described. So you'll definitely want to look at those types of things. But back to the subject at hand, the 3 top categories that we like our clients to understand are customer acquisition and retention, profitability, and liquidity. All of those things are critical to the long-term success of a company, and they actually feed off of each other a little bit. So let's talk about customer acquisition first. Some of the key KPIs in customer acquisition could be customer acquisition costs. So what does it take to get a customer to buy from you for the first time? That could be marketing dollars. That could be sales calls. So if you have a sales team that's actually on the streets making connections, that type of thing. It could be ad spend, whether that's on Facebook or other digital, Google ads, other digital things, whether it's direct mail and whether it's trade shows, there's all types of options like that. So customer acquisition cost, what does it take to get a customer in the door? Another customer KPI is lifetime value. Now, the application of lifetime value is really going to depend again upon the type of industry that you have, the type of business that you have, the types of products or services that you offer. So, as an example, if you're a construction company and you work strictly with residential customers, but you do so on a direct basis and they have a remodel, once that remodel is done, you may not see those customers again. So lifetime value is going to be very easy to calculate because it is the one job and is really, part of your average revenue per customer calculation, which could be another KPI that you would consider and maybe a more appropriate thing to track if you do not have repeat customers. Another customer acquisition consideration can be And this particular one is non-financial, and that is customer turnover. And what I mean by that is um, that if you have a business where you have repeat customers and those customers only have a life cycle of 3 months. And there's a reason for you to believe that they really should be staying for at least 6 months. Maybe not forever, but at least for 6 months. You want to be measuring customer retention. And customer retention, the more customer retention goes up, the more customer lifetime value should increase. And also, the lower your acquisition costs should be on average, because your customer base should start to consist more of repeat customers and less of brand new customers. And that's a great position to be in. You certainly always want to be bringing in new customers, but by the same token, you also want to have a solid base of returning customers. That helps keep your advertising costs down. It also makes just forecasting and budgeting and planning for things in your business a lot easier. The next area we're going to talk about is profitability. So this can easily come directly off of your income statement. The two most common measures are gross profit margin or net profit margin. Gross profit margin is most frequently used with businesses that have some sort of products for sale, whether those are products that they make themselves or those are products that they are distributing and somebody else is manufacturing them. There are direct costs associated with those products. You may have some direct labor in there, depending upon what type of organization you have. If you are a manufacturer, as an example, the labor that is in the manufacturing plant may be considered direct labor, whereas the administrative labor would be part of your operating expenses. That's a lot of detail, but that's just an example of the difference between gross profit and net profit. Net profit is the bottom line. Margin is that difference. So gross profit margin. Sometimes you will hear margin expressed as a percentage and just margin. You might hear gross profit margin percentage. Those are the most common. And one of the reasons that those are so widely used is because they're easy to calculate. There are standard definitions about what goes into those things, and you can easily find industry comparisons. So you can compare your company to other companies in the same industry and get a sense for whether what the results that you're seeing are just indicative of the industry, or whether there are some things that you can improve, or whether you're just knocking it out of the park and making much more money than those other companies. The other profitability things that you can consider looking at are any variable costs that are directly associated with revenue production as a percentage of revenue. So gross profit margin is one of those, but you could also look at freight, fuel, direct cost of goods sold, direct labor as individual components of the gross margin. Overhead expenses as a percentage of revenue are often a lot less informative, simply because overhead expenses tend to be fixed. And what's really driving the variability in their percentages is what's happening to revenue. So it can give you a little bit of a false echo. Other things to consider for profitability have to do with looking at financial information married with operational information. Example, average revenue per employee. Even if those employees aren't directly involved in the production of revenue, there are usually, again, industry standards or best in class elements of how much a certain type of company should produce in revenue per employee. One of the things that is going to help you understand is whether your operations and your staffing are happening in a way that is consistent with the revenue that's being generated. Said differently, it can be a really good way to look at how effective and efficient your overall company staffing is and whether there are any changes that you might want to consider. Other profitability measures could be if you have certain quotas for manufacturing or installation. I know one of our construction companies has an expectation of how many square feet of a certain product an installer should be able to do in any given shift. There are certain exceptions to that. Some things are more difficult than others, but that's an example of a profitability measurement because it gives an indication of how much work is actually being done for the dollars being spent on that person's pay. The last area is liquidity. The reality of it is lots of businesses are doing great, may have fantastic revenue, and go out of business, shut their doors because they simply do not have the cash flow that they need in any given period of time. One of the things that is always true is that you can control your expenses, but you can't control how fast your customers pay you. And regardless of the terms, regardless of the contract, regardless of the phone calls, regardless of any of it, you can't make them pay you on any timeline that's not theirs. So you don't have a lot of control over the ultimate payment receipt from the customer. You do have control over some of your expenses. You don't have a lot of control over paying payroll, paying rent, paying insurance. There are just some of those expenses that have to be paid when they're due. If you don't pay your contractors or employees, they're going to stop working for you, and then you have a different issue. So payroll is going to come every week, every 2 weeks, every month, regardless of when your customers are paying you. So one of the things that you really want to look at on the liquidity side is what is your cash conversion cycle? How long does it take from the time that you get the inventory in the door to when you sell it to when somebody pays you for it? Now, in some cases, especially if you have a retail business, the time between when you get it in the door and when you sell it is that's the calculation because you're paid immediately. In some cases, that's not the calculation. You get the product in the door, you sell it, you have 30-day terms. And so it takes you 30 days to sell it, takes you 30 days to collect. Your cash conversion cycle is 60 days. And in the middle of that 60 days, you probably had to pay for the inventory and you've had to pay your employees. You may have had to pay for at least part of the inventory in advance in order to secure the shipment. That is not uncommon at all. And so your cash conversion cycle is very long. And the more that that gets extended, the harder it is to kind of track and plan your cash flow. If you get into a rhythm and it doesn't change, then you just have a timing issue at the beginning. But cash flow can be one of the biggest areas that businesses struggle with if there's any sort of seasonality, if they have a very long cash conversion cycle, if they don't have access to other forms of liquidity that aren't generated by the operations, meaning they don't have a line of credit, they don't have investment capital, the owner isn't able to put in any more money. So liquidity measures are really important. Cash conversion cycle is part of that. Accounts receivable turnover is a calculation that can be done. Days sales outstanding is a calculation. Days payable outstanding is another calculation. In and of themselves, DSO, days sales outstanding, and DPO, days payable outstanding, aren't terribly informative. What is informative is what happens to those measures over time. Are they getting longer? Are they getting shorter? And how are they moving together? So let's just say, for example, that your company has a DSO of 45 days and a DPO of 30 days. What that means is you're paying your vendors faster than you're getting paid by your customers by about 15 days. As long as that 15 days stays constant, you're probably okay. But when that gap starts changing. Namely, if your DSO gets longer, but you're still paying everybody at 30 days, then the liquidity crunch is going to start to be very real and potentially painful, because you're pushing out cash faster than you're getting it in, and you're slower and slower to get it in. So those are some of the liquidity things that you'll want to look at. You can certainly look at cash in the bank. You can look at average cycles of payments. Cash flow is one of those interesting beasts, because if you don't have payroll every week, as an example, every other week, your cash flow is going to look awful, probably, because you have payroll, but you don't have the same bump on the cash collections or the revenue side that coincides with that payroll. And, really what you're looking for are the KPIs that are going to help you develop a monitoring system for all three of these categories: your customers, your profitability, and your liquidity, so that you can see big trends in your business. KPIs are really going to help you see that over time, much more so than any absolute dollars in any given period are going to help you do that. So tell me, which of those three categories means the most to you? Are you using KPIs in those categories? What are you getting from your use of KPIs, especially like liquidity and customer KPIs? I'm really interested to hear what you have to say in the comments. And please also remember to subscribe so you can be notified of future videos.